Shannon, and everybody, great having you on board with us today. We're going to spend a good amount of time talking about where we're at in this part of society right now with business and sales and our clients and tax confusion and that type of thing. My goal is to help you kind of make sense out of where we're at and how to take this information and share it with your clients to do something that works very well. So we're going to do the share screen part now. And then let's verify that everybody can see it.
Yep, you can see it.
All right. I did write a book, Tax Secrets Made Simple. And what I did in this book was to try to explain complex things in such a manner that people can go, we understand. The goal was to help them learn how to ask questions and help them find the right answers. If you want a copy of the book, a free copy digitally, just send me a note, say, hey, Ed, send me a copy of your book for free, and I'll be happy to fly it to you. Many of you have clients that are calling to say, I've got an unsolicited offer for my business, and it goes something like this. Hello, business owner, I'm Susan Smith, and I may have a buyer interested in buying your business for over $1 million. When can we meet to discuss this fantastic opportunity? We have never seen so much money in the hands of private equity and banking investment companies. It's just amazing at the amount of money that is sitting there that has not been deployed. So there's a lot of pressure and a lot of opportunity for business brokers to reach out to business owners and say, hey, let's sell your business. And the whole goal of this thing is to help people understand how to figure out the business transfer process. And I'm going to use some statistics today to kind of help you correlate as to what works. When we're having this discussion with a business owner or yourself as a business owner, you're going to want to sell your business when you want to, for the money that you need, and to the people that you choose. Now let's break this down. When you want. This discussion, I think, needs to kind of go better than just pick a date that you're planning on retiring. Too many times do I see the scenario begin with, what age do you want to retire? And there's nothing wrong with picking an age, but we also need to have the discussion, when is the right time to sell your business, regardless of your age? So for example, in 2006, if your client was 67 years old, saying they want to work another 2 or 3 years, and they had a willing buyer in 2006 willing to pay the fair market value for the business, but yet they decided to hunker down and stick it out for another 2 or 3 years, that may have been a very bad decision for them, because the value of their business may have gone down. They may have lost their business. But, we lost a lot of building construction companies in that time period. So this is why I say when you want is a 2-question point. Age is important, but condition, the right time to sell your business when things make sense. And then for the money you need, the primary phone call I get here is, okay, that's the right value for my business, but I need all of that money to give me the retirement income that I need going forward. And then the next issue is to the people that we choose. And oftentimes we have the idea that we'll transfer the business internally versus externally, but I'm going to show you the statistics on that. I think a great place to begin this discussion with your client is this little handout that's available to download in your materials. On one side, it's got this little 5 boxes of, preliminary financial needs analysis, who's going to be the potential buyer, what does the valuation of the business look like, what would be my future cash flow estimates from retirement, and my target departure date. And then on the back side of that form, there's 4 or 5 sentences for each one of these boxes to kind of help you build a conversation platform to walk the client through this. And if you use this as something annually to meet with your client, say, hey, let's talk about your business exit. It may be 10 years away, it may be 20 years away, or it could be in 2 months. But at least this gets them in the framework. I'm going to share with you the case study that we're going to solve in a little bit. So John and Mary Smith are age 65. They have an S corporation. They're the 2 shareholders. It's worth $5.5 million with a $500,000 basis. They also own the building outright. It's got a basis of 500,000, $5.5 million building. Notice I'm using round numbers here. We have an $11 million transaction with technically about $1 million in basis. So we end up with gain of about 10 million. I like using these round numbers because our brains learn faster versus using 7.6 million. You see where I'm going? And these concepts are going to work whether it's $1 million transaction or 200 million. They plan to sell this year. Oh, with one caveat, they want you to help them figure out how to sell zero tax. So let's get into this. The nightmare begins usually like this. Business broker calls to sell a pitch book. Business broker says, hey, I'm going to do all this analysis, build up this book to basically talk about what your business is and what it's worth. And hey, these pitch books are beautiful. Typically, the fee is going to be credited against the overall commission when and if the business sells. And just keep in mind, 2 years ago, the average number of businesses that actually sold was 1 out of 4 that got across the finish line. Client gets a letter of intent to purchase the business. Another value add that you can have with a client is to show them a letter of intent. Most sellers get into this process of selling their business and, oh, Shazam, here's a letter of intent to buy your business. And they're not prepared for it. They don't understand it. And so helping them understand that this is a basic letter of intent. This is what the sale of your business might look like. It could be 50% down, then 25% in 1 year and 25% with the following year. The terms are probably going to have some type of calculation on year 2 as far as maybe you get more, maybe you get less based on the performance of the business. Getting them prepared for that. They meet with you. And typically this is the expression that they have when you explain to them, oh, by the way, you're going to have some taxes to pay on this building. And we all understand the difference between an asset sale and a stock sale and C corps and S corps. And even though there's a lot of question as to what these things are anymore. Another thing that people get shocked in is that $2 million of unreported inventory that they have on the shelf back there. That it's amazing how many times, well, we don't have any inventory, or we've only got $300,000 worth of inventory, but yet when it comes down to the transaction, my inventory is worth $2 million. This is something we got to help these clients understand, properly reporting inventory every year. And they don't understand the installment sale process where we get 50% down, 25% and 25%, or I even had a case last year where it was going to be 10% down and the rest of the installments were going to be over 7 years. And they were convinced that doing a long-term installment strategy like that would reap them better tax benefits by spreading the distributions over a bunch of years. They were totally oblivious to the fact that what if your buyer runs the business in the ground in year 5? So there are pros and cons, and helping them navigate through the advantages and disadvantages of an installment sale is important. When we look at business owners, our business owners statistics, 56% of your business owner clients today will exit their business in 10 years. 75% of your business owner clients would sell today if they knew that their financial security was assured. 80% believe that a successful business exit results with careful planning, usually through you. 28% of business owners have discussed their exits with their spouses and family. Okay, yeah, that's kind of ridiculous. So 1 out of 4 people have said anything to their spouse about selling the business. But only 3% of business owners have talked to someone they consider to be trained in or an expert in exit planning. 7.4% of business owners have done nothing at all. But 100% of our business owners will leave their business at some point. I call it the 4 Ds: death, divorce, dissolution, and disability. So they are going to transfer their business at some form or another. And every now and then, Rod's going to jump in with a polling questions, just so you guys know, okay? Now, business owners, they think that we will have this inside sale 2/3 of the time to somebody we know internally. And only 1/3 of the business owners believe that, okay, an outside sale. Reality is this: less than 1/3 of transfers are internally using an ESOP or a fractional ESOP structure, some type of EAIP. And by the way, real quick, the ESOP structure is great when you've got enough employees. Revenue models are great. The census for the employees as far as ages work. overwhelmingly 1 out of 20 times the ESOP is a great structure. And I love the ESOP structure when it's the right fit and the feasibility study's been done to make it happen. I love the fractional ESOP structure as well. But for our smaller businesses, like that 10, 20 person firm who wants to do the ESOP, they probably won't qualify and the expense is probably not going to pencil out. Check out what's called the eligible individual account plan. It's kind of like a pension planning model that looks, smells, and tastes a lot like an ESOP. It's not an ESOP, but it acts a lot like an ESOP. And it's another great way for a business owner to transfer ownership interest to the employees in a way that maybe doesn't qualify for an ESOP. Maybe 2 or 3 of the key employees are going to buy the business together as a group, or maybe a family member. Some of the technical issues we have with key groups and family is their credibility to borrow money at the bank to buy the owner out. So that's an issue. And because we realize that only about 1/3 of the transactions actually go internally, that means 2/3 or more is going to be a sell to an outside third party. Rod, do you want to do a question at this point?
Sure enough. So our first polling question's up on the screen. You've got 60 seconds to answer, and Ed, you can keep going.
Are you still listening? Probably not. Okay, and the clicker's not clicking now. Oh, I have to answer too, it looks like. All right. When we look at the last couple of years of transactions, this is from Biz Buy Sell, and they do a great job of collecting statistics. When we look at 2018, it was kind of okay, up and down, kind of solid. We went through the election. We look at the 2018 to 19, notice in Q4 of 2018, a drop, a noticeable drop. If you'll remember correctly, that's when President Trump started this tariff war with China. And what it did at the end of those time periods, and we saw this in 2019 and Q4 as well, we saw a retraction of the investment market. They got a little nervous on things. Elections causes them to get nervous, tariffs causing them to get nervous. And so we saw in Q4 of 2019, things kind of go down. And then we saw in 2020 Q1, okay, not so bad anymore. And then Q2, of course, that's COVID. So we have this weird COVID, bar there in Q2 of 2020. And then we saw a big hike in Q3. And many people are surprised we saw such a spike in Q3, but really that's just stuff that was already in the hopper that ended up moving into Q3 as the dust settled with COVID. And then we got Q4, and then we have Q1 and Q2 going in here. We're starting to see recovery. I will say this, from the business owner perspective, when I look at the amount of money, we have $2 trillion that has been undeployed in private investment capital, either through private equity or through investment banking. I predict we will see the highest number of business transactions this year in Q3 and Q4 than we've ever recorded, unless there's some new tipping point to once again cause the investment capital people to retract the money and basically just go to safety. So earlier I said 56% plan to exit in the next 5 to 10 years. When you look at this chart as far as when people plan to retire, is it in less than 5 years, 5 to 10 years, more than 10 years? Notice you got 7% that never want to exit. So I guess that group of people is just going to die at their desk or something, which they can do. And then you got about 16% that are undecided. So that kind of gives you the framework of the reality of when people will actually retire. And then when we poll business owners about their exit, and they could select more than one option here, we still see that the unrelated third-party buyer is high on the list when they can't do an internal sale or that type of thing. So it kind of gives you perspective that the reality is it's more than likely going to be a third-party sale, and that internally, the key thing I try to tell families when they're going to do an internal transfer to family or key employee, you really need to begin that process not less than 5 years prior of your targeted departure date, preferably 10. Internal transfers, when the people that are going to receive the business don't have the money to buy the seller out. It just takes a lot of time. The next issue we have is what business owners think their business is worth. My business is always worth more than my friend John's business, which is the same thing. So the independent valuation thing is important here. The informal methodology, I get a little nervous because what does that really mean? And then we got 21% that they just don't know what their business is. So one question that I have for business owners is, when was the last time you figured out what the value of your business was? And one thing that I typically find business owners are kind of shocked to hear me say is, go to the bank and apply for a loan, a business loan. Because the hoops that you have to jump through to qualify for a business loan answers a lot of these questions, doesn't it? Even though they may not need the money, just going through the process of qualifying for a loan helps them see what the value of their business is. And when we rack and stack the actions that an owner has taken towards their exit plan, notice 59% at the very bottom, the first thing they look at is, how much money am I going to get? Will it solve my retirement income? Yeah, and family, discussing with advisors, internal parties, built succession plans. Now look at the blue box at 40% hired management team. It is so important that we not only hire well, but if you're planning on selling your business externally, you've got to figure out a way to hire people and handcuff them to the business as part of your departure plan. So when you're hiring those executive staff people, executive sales people, et cetera, and you know that you're planning on leaving the business in the next 5 to 10 years, it's really important that we incentivize those key people to stay with the business as part of the buyer's opportunity to see value in the seller's plan. So when we're able to represent to the buyer, by the way, these 3 people have handcuffs, these are their incentive packages that we built in for them, it helps the buyer add value. So the more we can do there to build that team is really important. Another thing that I find missing all the time is the continuity plan for the business owner. If the business owner is in a terrible car crash tomorrow, but doesn't die, but is incapacitated, okay, who's going to run the business? Who's going to step up to do what? What's going to be the process? Should we sell? Who do we know that's interested in buying the business? All of those things need to be a part of a written continuity plan for the family and even the executive leadership, so that if the CEO, for whatever reason, can't be there to make decisions anymore, what's the plan? Get evaluation every now and then. What are some written plans to transfer ownership, which kind of coincides with the continuity plan? And then it's decided whether or not there's even a buyer for their business. I think we all realize that some of our clients' businesses will never transfer. They're just not transferable to a potential buyer. They don't have value in an open marketplace. They're basically a job for some of our clients, and that's fine. But for some of our clients, they need to be looking at more than this one. You know, Rod and I were talking earlier. The key thing that I try to get business owners to understand is run your business as if it is for sale every single day. And if you are running your business, that means it's being polished all the time. That means your accounting numbers are good. That means everything you're working on is a perfect thing, okay? So run the business as if it is for sale every day. And I'll ask the business owner which method of accounting they use. And sometimes I get that kind of look at the deer in the headlights. And it's cash accrual, and every now and then somebody will say ATM. That's the new accounting method that was recently introduced called the automated teller machine. This way they go to the bank, get the printout, what's there. Methods of reporting. We all know what these things are. And the client goes, oh my gosh, that cost a lot of money. Well, it probably doesn't cost a lot of money when you look at it from the big picture perspective. When you're doing some form of audited or reviewed financials, it can help identify what part of your business is falling short or needs to be improved. So whenever somebody says, Ed, why do you need to see something reviewed or some compiled or an audited financial statement? It's because this is the first thing that the buyers are going to ask for. They're looking for concrete evidence to basically validate your representations of what your business is about. It's really important to do these every now and then. Of course, some people are complied to do some. So the seller needs to know, how much income do they need post-transaction? And I'll ask them, okay, net of tax, what's it going to take for you to live on? What do you need if you sold your business as far as your targeted monthly number for the rest of your life. What's their basic and current value of the business? What's the basis? How do we build value if we maybe don't have enough value here in the business to sell to give us the income that we need? Understand why we have to build a team of exit advisors and get a team put together. How do we minimize income going forward? And how do we control capital gains taxes? And we're going to definitely work with that in a moment. We're going to talk about the purpose of the pitch book and what the broker's role is. How to prove up the value of your business. It's amazing how I'll ask a business owner, all right, prove to me your business is worth $3 million. And they typically can't. What market value and multiple is realistic? And we have definitely seen some market values and multiples kind of go crazy this last year in some cases. And what are buyers looking for? Well, the buyer's looking to buy for the lowest possible cost. A couple of reasons for that. One, they don't want to spend their money. Two, maybe they're unable to borrow as much money as they thought they could get. So they're always trying to figure out how to keep the most credit lines open and the most cash on hand, which means they want to buy at the lowest price possible. Well, in a hot market like this, sometimes buyers are going to have to pay a premium. Understanding the game. Understanding that when you get ready to sell your business, it is a roller coaster. It's not something like we go to the car dealership, we haggle over the price of my old car, haggle over the price of the new car, and then we figure out what we're going to pay. And we're out the door in 2 to 3 hours. It's nothing like that. So understanding the game of qualifying buyers and figuring out how to get the broker to do his or her job so that we can get the highest possible multiple. All right, Rod, are we at another 10-minute mark?
Yes, we are. And here's your next question. You have 60 seconds to answer the question. And Ed, if you would keep going. Thank you.
And for some reason, it does not like it.
Yeah, it freezes the screen when the polling question comes
There
up.
we go. I thought this polling result was kind of interesting. Who do the sellers trust? Far right-hand side, the business consultant. The banker, the kids, the financial planner, the business lawyer. I really thought the business lawyer would be over where the estate planning lawyer is. And I really figured that the accountant, CPA, tax professional would be a lot higher than any of the attorneys, but we still trust our spouse more than anyone else to talk about the value of our business and who do we trust. And so at least the tax professionals in the top echelon here, but I still don't know how the estate planning lawyers got that high on the list. Here's the hard part. Will the net proceeds from the sale provide the income or lifestyle that you need or desire? And as long as we can keep the client focused on that, and we can get the client to help us understand any major cost expenses they're going to have post-transaction, it can help us better plan for what they're trying to look for. Now for the advisor, the fun part, the forms, documenting what our client just did. Hopefully they were in your office before the transaction, but sometimes they do the transaction, they show up into your office with everything else signed and pretty and say, by the way, I sold my business. Here's the stuff you need, I think. Well, we're going to report this on an 8594. It is important to look at that form. And if you've never done a business transaction, I would beg of you to co-counsel with another tax professional who has done several and let them walk you through it to learn the ins and outs. It is something that does have to be communicated and coordinated with the seller and the buyer because both these forms kind of need to reflect the same thing. So it has to be reported properly. Oftentimes there's going to be an installment sale. So we're going to have an IRS and California form on that. And by the way, if there is no gain, there's a form for that too, or Schedule D. So there is some reporting responsibilities here that we have to document this transaction. Here's the 8594. And of course, when we're trying to sell something, we think it's a Taj Mahal. Of course, the buyer thinks it's like this little log cabin on the left-hand side. A couple of things to know about the acquisition statement down at the bottom. It will often ask the question, is there going to be any type of non-compete agreement? And of course, that's going to be an ordinary income tax calculation. Sometimes it's defined in the purchase agreement, sometimes it's not. So this is one of those things you have to really carefully look at to make certain it gets properly allocated and reported, okay? And of course, here's the installment sales. The federal and the state forms pretty much are almost the same. It's just a matter of documentation for it. So it's not too bad. But again, if you have not done a couple of these, it would be wise to have co-counsel work with you to make certain you're reporting things properly. So we got across the finish line, we sold, we have our tax bill created, and then we're going to take those net proceeds and probably put them back into some other investment strategy where we're going to continue to lose more money on income tax, capital gains tax, and potentially estate taxes. One thing that people often forget about is when they sell their business, they lost that so-called corporate veil of some level of asset protection against creditors and predators. So now we're cash and we no longer have that corporate veil. So now that you've got $5 million of cash sitting in your bank account, how are you going to protect it from bad guys? So we need to always be helping the client understand, once you take the cash out, how are we going to store the money and what type of business entity or structure to give you some degree of asset protection from things that happen. So going back to where we started, we want to sell when we want for the money that we need to the person or people that we choose so that we can retire. Oh, and pay no tax. In fact, pay no tax on the transaction, but figure out how to pay less tax or no tax in retirement. Here's the challenge that we all have. It's called the law of primacy. Whatever we teach somebody how to do first, whether right or wrong, they will typically remember to do it that way for the rest of their life. The challenge we have as tax professionals, most of our clients never really learned how to properly use the tax code. They learned how to pay tax, but they never learned how to use the tax code in a way to help them make investments and do things where they have less tax exposure. When you look at poor people like Warren Buffett, Bill Gates, Mark Zuckerberg, and people ask them, why are they in such a low tax bracket? It's because they know that there's 80,000 pages of tax code to help them pay less tax. We all have the same right to use the same tax code. We live in a confiscatory tax system. This is pretty much what we've been taught our entire lives. This is what we can keep after tax. This is the IRS donation that we pay to the state. That's just the way it goes. And I ask this question all the time: will future income tax rates decrease, stay the same, or increase? The answer is yes. I mean, when we saw TCJA, did it increase, decrease, or stay the same? Yes. On Biden's plan, decrease, stay the same? Yes. So the game about rates is something people just truly don't understand at all. It will always be in change. The most important thing that I think most taxpayers don't understand is the income tax in respect to how is it that we have income tax rate that's 37% under TCJA and it's 37% under the Biden plan, but yet the threshold, or what we call bracket creep, is much, much lower. Most consumers in America don't understand that discussion. And for your clients who have a hard time with this process, I've got a little 5-minute video from Dr. Art Laffer, and he's a big time economist. He used to serve here in California for many years. He was on the governor's board, brilliant economist. But let me let you see what Dr. Art Laffer says about this thing of taxation and high tax rates and low tax rates. And this is a great video to share with your clients when they're trying to figure out the tax code and where they fit.
So you asked me, what is the Laffer curve? Now, in all honesty, the Laffer curve that you may see is my profile, but no, it's not. The Laffer curve is a relationship between tax rates and total tax revenues. And by the way, I did not name it the Laffer curve, and it's been around for centuries and centuries. In fact, the first reference to it I already know is in the Muqaddimah in 1381. Ibn Khaldun describes it this way: at the beginning of dynasties, tax rates are low and revenues are high. At the end of dynasties, tax rates are high and revenues are low. That's the sort of logic behind it. But let me, if I can, say, how much would you work if you were taxed at 100%? So that every time you go to the office, instead of getting a check, you get a bill. Obviously, you wouldn't work at all. There would be no work, but also the tax revenues would be zero. Now, that's this point right here on the Laffer curve. At 100% tax rates, No one will find there's any incentive whatsoever to work. They won't work, and tax revenues will be zero as well. Now, as you start lowering tax rates, to 99, to 98, to 97, somewhere along the line, all of a sudden, you're going to find it worthwhile to start working, and you're going to see revenues starting to rise. The other point of the Laffer curve that's fixed is at zero tax rates. At zero tax rates, so there are no taxes. Of course, the government's not going to collect any revenues. We're going to have a lot of output, employment, production, but there'll be no revenues, and that's this point down here. And again, at this point, if they start raising tax rates, as they start raising tax rates, what you're going to find is the revenues are going to increase, but they're going to increase at slower and slower rates. And these two curves will come at a point, the maximum point out here. Now, the key thing about the Laffer curve that makes it fairly interesting for politicians is to remember it's a pedagogic device, not an explicit measure of any one country. But what it does show you is that there are two tax rates to give the same amount of revenue. There's a high tax rate and a low tax rate. No country should ever want to be in that high tax rate range. I mean, why would you ever want a tax at this point where if you lower tax rates, you collected more money and you have more output, employment, and production? So this is the Laffer curve, which really brings together the debate about taxes. There are two effects taxes have on revenues. Number one, which we call the arithmetic effect. If you raise tax rates, you do collect more revenue per dollar of tax base. That's the arithmetic effect. But there's also the economic effect, which if you increase tax rates, you reduce the attractiveness of doing the activity, and you will shrink the tax base. These two effects, the arithmetic effect and the economic effect, always work in the opposite direction. In this range, the arithmetic effect wins, and you get more revenues by raising tax rates. In this range, the economic effect wins, which by raising tax rates, you actually get less revenue because you do more and more damage to the tax base. And that, ladies and gentlemen, is the Laffer curve. Thank you.
Now, Dr. Laffer's a hoot. He is just so much fun to talk with on the phone. All right, Rod, we're at another 10-minute mark. You ready for another polling question?
It's up and it's running. You got 60 seconds, so please cast your attendance proof and you can keep going, Ed.
All right. All right, so what would a fair income tax rate be? And in the discussions that I've had over the years with business owners, we talk about this a lot. You know, am I paying too much tax, and what would be a fair tax? And some of the information that I get from a business owner is kind of interesting to hear their thoughts on how much tax is enough. And typically what I find is that the business owner is not disappointed in paying tax. Most business owners are disappointed with how their tax money is used by our governing authorities. They just don't believe that they're using the hard-earned money that they gave them to support the nation is being used in an effective way. And so their point is, I'm overpaying my tax because I'm not getting any value out of the tax that I'm giving our governments. We all know these things in our TCJA. We've practically doubled the standard deductions, California tax rates, 13.3 over a million, the cap gain rates, the gift tax rates, the estate tax. You know, all of these are in question to be changed under the Biden plan. And this is going to be a crystal ball discussion for a long, long time until something gets put into place. But one thing I'm often reminding the clients, the TCJA system does expire in 2025 anyway. Some type of tax reform has either got to be introduced before then, or we're just going to go back to the old plan, which was nowhere near like this. The one thing that I think is really important here is that estate tax exemption, that lifetime unified credit, changing that from 11.7 down to a low number like 3.5 or 5 or 5.5 million, that is going to radically change the discussions that we have with a lot of our clients about doing more income tax planning and estate tax planning, while at the same time we're trying to figure out the business exit plan. The Biden plan is going to make exit planning a lot more tax complicated. So let's discuss what we don't know. 60% of income tax is optional, 100% of long-term capital gains taxes are optional, and 100% of estate taxes are optional. And this is where not being in person with you to see the audience and your expressions when I share that is when people just go, this guy's lost his mind. This is not true. Well, I'm going to prove that out for you. So what does all this mean, kind of bringing this together? Most owners likely don't have a full view or understanding of the exit paths that are available to them. They just see, I got to sell to a third party, or I'm going to sell to my son, Joe. They're wrong. They're woefully unprepared for the exit of their business. In other words, they're ready to go, but the business is not in a position where it can continue to run without their daily leadership, because the business owner has really created a job. I had this discussion with somebody here recently in Northern California, and he was complaining about his time management and all the things that he was doing. And I finally said, hang on a second, you're doing this and this and this and this every day? He says, yes. I'm like, you should only be paid $15 an hour. And he looked at me kind of upset. I'm like, look, you're not a CEO. You're a guy that owns a business, a couple of businesses, and you're doing all of your assistance work. No one's holding you accountable. So for the purposes of helping you understand your value to this business, you're worth $48,000 a year. That's your worth to this multi-million-dollar business. And by the way, if you've got the term CEO in your business card, you should take it off and change it to owner, because you're not a CEO. You're an owner who's making $48,000 a year in a business that could be making a whole lot more, because you're too busy doing your assistance jobs, making copies, paying payroll, etc. Your business is not transferable, and you're being overpaid if you're taking out more than $48,000 a year. So he sent me back a text going, Ed, that was really startling in the way you told me that I'm doing too much of my assistance work and I should only be paid $15 an hour. What should I be paid? And I'm like, easy, $500 an hour. So I got a text shortly after that. He says, Ed, that's $1 million a year. And I'm like, exactly. If you had quit hanging out at the copier, if you'd quit doing payroll, if you'd quit sweeping floors, if you'd quit doing all these other things that your paid 40 employees should be doing, you could probably make a lot more money. So for a person like that, who is so hands-on, their business doesn't have value, nor is it going to transfer internally or externally very well. Owners are looking at multiple exit paths at once without an exit professional. They're literally using a dartboard going, okay, we should do an ESOP. We've got 3 employees, so let's do an ESOP because my financial planner said we should do an ESOP. Well, technically, you can legally do an ESOP with 1 employee. That was a huge court case called IRS versus Steel Balls, believe it or not. And then also, owners may have the wrong predetermined exit path based on assumptions. In other words, they're not doing the analysis on the different exit paths, let alone the tax paths that can net them more money and better retirement income. So one thing I think we tax professionals need to do is to help the owner prepare for the fact, what if you could sell tax smart? And too many times the owner is so focused on just the tax smart transaction of only the business part, they don't open up their mind to other things that we can reposition to create offsetting deductions. Maybe they have a 5 to 10 year structure for an exit timeline. Maybe a tax deferral strategy is going to work. Maybe some type of ESOP or EIP is a better fit. Maybe they need to shelter money over time in something like deferred defined benefit, particularly if they're going to do an internal transfer. And what if they could transfer inside with limited or limited transfer value? Okay. The purpose of the government taxing us is to collect revenue, like Dr. Laffer said, for the purpose of paying for the cost of the government and what the government provides. When I give the government $1 of income tax, we have about 27% tax efficiency. But when I give $1 to a worthy charitable organization, I have a lot more efficiency. The reality is this: the more charities that have more money to solve problems, to get the government out of the problem-solving business and let the government focus on just doing government, we could do so much more with a charitable dollar than an income dollar. So to put this in perspective, if your hometown is going to have a soup kitchen and it's going to cost a charity $1 million to set it up, payroll, etc., for the IRS to do the very same soup kitchen in your hometown with the same results is going to take about 3 million income tax dollars. So that's almost a 3-to-1 opportunity there. So we need to get the government out of the solving problem business and let charities solve the problems. And when we talk to clients, notice that blue, that pure charitable intent up there, 20% blue. We have so many clients that are already giving this just wonderful. Then notice the red 20%. Those are people who care less if mom is in the line at the soup kitchen. And then people are receptive to the charitable discussion. It's just most of us are afraid to talk about it. So more cash means doing more good. So if the client can pay less income tax, less capital gains tax, grow the business, build value, increase their retirement options, give more now and later to charity by creating more tax deductions, it gets us in a discussion with the client where we get to start talking about more than just financial things. Because when we get the client to start opening up about if you had to give $100,000 in tax to the IRS, or if you had to give $100,000 to a charitable organization, which one makes you feel better at night? And most of us advisors are a little nervous of those kind of questions in those discussions. So tax transactions, as far as reducing issues, if you have a client with a C Corp, remember 1202, section 1202, there are some provisions in here for the older C Corps where they get some tremendous tax benefits. C Corp transactions for older ones, give that one a look. Long-term installment notes, promissory notes, deferred sales trust, charitable trust, grants. I think the grants, they've been under attack for so many years, but I think they're still a great tool to use, particularly on an internal transfer. Installment sales with commercial notes, again, ESOPs and intrafamily transfers. Remember those ESOPs and intrafamily transfers, you need some ramp time for that. 3 years ESOP planning is a good way to start. Advanced tax planning, people start going, oh my gosh, well, let's do some baby steps here. Let's get you started with baby steps. All right, Rod, I was just about to call you up.
Well, there you go. Your next question's up. Please register your attendance. 60 seconds. You got the answer. So Ed, you can take it away.
All right, thanks, Rod. All right, we're going to learn everything we need to know about advanced tax planning over the next 20 minutes. I use round numbers again, $1 million taxable income. You pulled off every miracle known to man, claimed every expense possible, and your client is sitting there with $1 million taxable income, state and federal. All right, here's a trick question. This is a trick question. What is the max amount of cash that I can claim as a charitable donation? Well, technically it's $600,000. However, for this year, for 2020 and 2021, the CARES Act allows us to give cash to be deductible on our federal returns up to 100%. So this person, for the first time in history, if they were to give $1 million cash to a qualifying charity, this does not include private foundations, this does not include charitable trust, this does not include donor advised funds. An operating qualified charity, if this client gives them $1 million under the federal side, they can claim all of it. Most of us know that under the normal rules, it's a 60% tax deduction that we can claim, which means the client legally can give as much as they want. So if the client wants to give $3 million cash to charity this year, they have that right. This year they can claim $1 million of it, up to $3 million of it if they have $3 million of income. If they can't use it all, it's a carry forward. Not too bad. When it comes to assets, publicly traded stock, land, there's a 30% rule. And then remember, there's also a 20% rule here. So if I have a client getting ready to sell their business and they're crying about losing 30 or 40% of their business in taxation, and I understand that we can do some charitable tax planning that can help reduce some tax exposure, that create charitable retirement income planning strategies, maybe we're going to kill 2 or 3 or 4 birds with one stone here. So to introduce you to the effectiveness of charitable tax planning, and this is a baby step that I beg of you to start teaching with your clients yesterday. So here's an example. 5 years ago, the client has $40,000 made 4 $10,000 investments in stocks, publicly traded securities. The bottom one is still worth $10,000 5 years later. Notice the next one grew pretty nicely at the beginning, but in about a year or two kind of flattened out. It grew to 50,000. It's been flatlining ever since. The other two had just been great. They've done very well. I love the fact that my $10,000 over the course of 5 years has turned into $90,000 or $110,000. So most of us know the term tax loss harvesting. I want to introduce you to a new strategy called charitable tax harvesting, okay? When you look at your client's return last year and you notice Schedule A line 14, they gave $50,000 cash to one or more charities, and you put it on the form. You brought it over to page 1 of their 1040, and it's greater than the standard deduction, so you claim Schedule A. Okay. When we look at that and we have the discussion with our client about, hey, I saw that you gave 50,000 cash to the charities. Would you be open to maybe giving $50,000 a different way and making more money off this? And this is where people get confused. If I give $50,000 cash to charity, it technically is a basis. And if I'm in a 50% tax bracket, again, I'm using round numbers to make us learn easier and faster. If I have $1 million AGI, I donate $50,000 cash to my church. I get to claim $50,000, so it bumps me down to $950 AGI instead of $1 million. Technically, it's going to save me about $25,000, right? So to make this simple to understand, I gave $50,000 cash to the charity to buy me $25,000 of tax savings. Okay. Yeah, there's a few percentage points here in reality, but to make the math easy for us to teach and learn fast, $50,000 cash bought me $25,000 of tax savings. What if I gave $50,000 worth of highly appreciated, poorly performing stock? Well, let's look back here. Do I have any appreciated, poorly performing stock? Well, it just so happens I've got $50,000. 5 years ago, I put 10 grand in here. It's up to 50 grand. But if I sell it today, I got to pay capital gains taxes on $40,000. Well, that totally is adverse to my wealth curve. So I'm just going to sit on this investment. Maybe any minute now it's going to go up in value. Yeah, sure. So instead of giving cash, what if we gave the $50,000 block of stock that has a $10,000 basis in it? And again, I gave $50,000 to charity. We're below the 30% number, so we don't have a problem here. 50% tax bracket. Once again, my $50,000 block of stock bought me $25,000 of tax savings. And this is where people's brains just don't get it. One of these two models right here created a $15,000 net profit for the client. So let's make certain we get this baby step understood. I gave $50,000 block of stock that cost me $10,000 5 years ago. I just bought $25,000 of tax savings with $10,000. So I have a double tax benefit here using the stock, because when I gave cash, 50,000 cash only bought me 25,000 of tax savings. So the smart play here is when the client is willing or has appreciated assets like this poorly performing block of stock that's appreciated, we tell the client, take that check for $50,000 that you were going to give to the charity, go to your financial planner, give that $50,000 new cash to the financial planner to buy a new stock with a new basis, and let's give that $50,000 dead on arrival block of stock that's no longer climbing to charity, get the same tax deduction as far as how it looks on the forms, but you end up with a net profit of $15,000 that we can basically apply to your other tax bills. Learning this baby step right here to start teaching this to your clients, and you know they're philanthropic. You see it on their Schedule A. They gave $23,000 to their church. Okay, they have an investment portfolio. And let's start looking at culling out these poorly performing assets. Let's give those things to the charity, replace it with new cash that you were giving to the charities anyway. The client is better off this year. The client has new stock that's hopefully going to grow. Everybody wins here. The charity still got $50,000. But what really happened here is because you stopped and said, client, you're a philanthropist, you're giving, let me show you a more productive, efficient, profitable way to give. It creates the platform where you, the Brainiac advisor, are now their go-to resource when they call you saying, by the way, I have an offer to sell my business for $1 million. What are we going to do? And then you start working with the client about their exit, and they go, oh my gosh, look at this huge tax bill. And then you introduce, by the way, here's some more charitable tax planning strategies. It's going to be well received. because you taught them last year or 2 years ago or 5 years earlier how to profit off charitable giving by giving stock instead of cash. They think you're a genius. And by using some type of charitable retirement plan to soften the tax bill off the sale of their business, we're now solving part of the problem, which is I can't sell now because I'm going to lose 30 to 40% in taxes, and I'm not going to have enough principal to give me the income stream that I need for the rest of my life. And then you go, well, what if we did a charitable trust or something to create some new tax deductions to offset part or all of this new tax bill? That discussion wins whenever you planted these seeds, the baby steps. When the client shows up in your office and they've never done anything like this, and then you roll out, hey, let's do this charitable tax planning thing. As soon as they hear the word charitable, their ears close up, their brain turns off, and they're out the door. You want to help clients pay less tax, start using Schedule A line 14. It is the most powerful tax savings process we have on a tax return. So teach them how to make money off their gifts. You will become their number one go-to person. And this is the 1040. It's going to change, of course, for 2021. And we're ready for another poll question.
Okay, it's up. You got 60 seconds. Please cast your attendance proof. Thank you.
Thank you, Rod. So chances are I don't need to spend any time on a 1040. And it didn't click. Uh-oh. Here's Schedule A. You know, we did see that change a couple of years ago, reduce the number of questions, but this is my favorite part of Schedule A. Just my favorite part. Just love line 14. And every time I sit down with a family and I look at their prior tax returns and we look at the charitable giving, and I start asking them, what are the charities important to you and why? I had this discussion with a lady yesterday. She just sold a $20 million apartment complex. She's got a $5 million capital gain. CPA's pulled off every miracle known to man. And she's sitting there upset about a $5 million gain. I'm like, okay, what's the purpose of all this money? You know, what's the retirement strategy here? What are you really trying to accomplish? She has no kids. She's divorced. And so we started talking about the fact that the bulk of her estate when she dies is going to go to charity. I'm like, that's kind of a shame. You're going to be giving nearly $20 million of your estate to charity when you pass away, and you're not going to get an opportunity to use any tax benefits because you're not doing any tactical planning right now. So needless to say, I'm at her office with her financial planner on Monday to start talking about how we can solve this $5 million capital gains tax bill she has. She's philanthropic. As soon as I started walking her through some philanthropic concepts, she's like, I've been looking at that. I didn't understand it. Oh my gosh, when can we meet? As soon as possible. People are receptive to charitable tax planning when you can show them that they can at least break even in most cases, and in many cases actually profit. So is there a better way? And by the way, my Olympus Tax website has got a lot of white papers that I spent a lot of money on exit planning. Feel free to go to olympustax.com and then look at the white papers on there. There's a ton of them on there. Deferred tax strategies. In respect to charitable planning, this is where people get confused about the AFR rates, the 75/20s, future value. Let me make this real easy to understand. When it comes to something like a charitable remainder trust or a charitable gift annuity, and we put $1 million into a charitable remainder trust, a charitable remainder unit trust, why is there a difference between the donor who's age 55, who only gets a $320,000 deduction, versus the donor who puts the same amount of cash into the same instrument? He or she gets a $600,000 tax deduction. And for some reason, people have a problem understanding the deductibility, why it's higher for older people and less for younger people. Well, it's this simple. That person who's 55 years old is going to live a lot longer, which means it's going to be a long time before the charity gets any money. Whereas that person who's 75 years old, they're closer to getting meeting God in a very few number of years. They should get a higher tax deduction. So age, all of this has to come together to create the charitable deductibility. And advisors, I got to tell you, watch these attorneys and help them stop making these mistakes. It's amazing at the number of charitable trusts that I see written by attorneys who have no tax knowledge whatsoever. And they go, here's a charitable trust for somebody who's 60 years old, and we're going to have a 17% payout. And I think any of us who have any charitable tax planning software know that we're not going to pass the 5%, the 50%, and the 10% IRS test to make certain the charitable trust is going to not implode. So keep a handle on these attorneys. They don't understand this thing, okay? Retirement planning, the financial planner is always camped out right here. Let's put money in a qualified plan because it saves you money. No, it doesn't. When you have a Roth versus a traditional IRA, if you're in the same tax bracket and going in and the same tax bracket coming out as far as the Roth or the traditional IRA, if you have the same rate of return for both of these concepts, so same tax rate going in, same tax rate going out, same rate of return, which one is more better than the other? There's not a penny of difference. The only time the traditional IRA wins is if your client retires poorly. In other words, way less income is when traditional IRA wins. But when it's apples to apples, Roth, traditional IRA, it's amazing. People just don't understand that. So if the goal is to retire with less income, traditional IRA. Below the line, which is what I call charitable tax planning, there are countless numbers of charitable strategies to use. The charitable remainder trust is kind of like the one that's always pointed to, talked about. It's great. It's the most commonly used in the nation, but there's tons of other tools that can get us there. So let's start having some fun. We've only got about 40 minutes or so to wrap up this case with John and Mary. S Corp shareholders, 5.5 million. They own the building. They plan to sell. What's their estimated tax? I always begin here. The do nothing strategy is what happens if we do nothing at all. So I'm using, again, a round number, 33%, because remember, I'm from Alabama, 2-digit IQ. I have to be able to talk nice and slow. That's the tax bill. And then net of tax, that's what we go home with. And then the commercial building, it's been fully depreciated. I'm going to use 40%, again, round numbers to make us learn better and faster. Total tax bill, $2 million. So when I back out my basis and my gain, client goes home with $7.3 million. The IRS goes home with 3.6. When you start thinking about the wealth retirement of $3.6 million at 5% a year, that's a chunk of money. It's also a chunk of money when you take a zero off of this thing. The client has $700,000 and has a $360,000 tax bill. That $360,000 wealth loss to that tax gods is important, and it does impact their way to think. So one simple way that worked for Mr. and Ms. Smith was this. We sell the business outright, trigger the tax bill. We donate the building to a charitable remainder unit trust, a 2-life charitable remainder unit trust, which is a charitable gift. It's irrevocable. Now keep in mind, you really need to have some experience here. Debt's a problem. If the attorney has not done 4 or 5 of these charitable trusts using real estate, you're really going to need to insist that he or she bring in co-counsel, because there are some pretty significant technical rules here for putting an operating building into a charitable trust. So the tax plan, $3.6 million loss, client goes home with $7.3 million, puts it into some type of income stream producing 6% a year, and the computer says they're going to live 30 years. As far as the exit plan, we have a tax bill from the S Corp sale. The building goes into a CRUT. We sell the building zero tax because it's tax exempt. So now there's $5.5 million in the charitable trust. And because it is a charitable trust, we get a tax deduction. So notice $1.5 million in tax deduction because of the gift of real estate. Notice how close that is to the $1.6 million tax bill. Oh my gosh. So we end up with, it may take a year or 2 tax returns to wash this thing out, but we end up with $11 million under management with a 6% return on investment using the same financial planner. So client, would you rather have $660,000 of combined income stream for the rest of your life, or would you rather have $441,000 of income stream for the rest of your life? This gets to be a no-brainer, doesn't it? And then people go, well, Ed, the 441,000 compared to 660, yeah, that's really important, but you're giving away the value of that building when mommy and daddy die. Okay, since we've got an extra $219,000 to work with, compliments of us not paying any tax, why don't we just take $55,000 a year and buy a life insurance policy to replace the value of the building for the kids' inheritance? I mean, come on, folks, this stuff is kind of simple here. When you've got an extra $219,000 to work with, there's all types of things mommy and daddy can do to live a better life and make certain the kids inherit a great value. All right, Rod, are we close to another number?
Yeah.
You want to just draw it off, I'll bring it back.
Oh, okay, so the question's up. You got 60 seconds to answer.
You know, it's the same question every time.
Yep.
All right. All right, so for John and Mary, clearly they're going to choose $660,000 instead of $441,000. Yeah, it's all ordinary income. I'm just trying to keep this real simple. So no tax planning. They die on time, 13 million. Doing the charitable trusts, they get 19. Again, no brainer, isn't it? When we look at the wealth transfer to the kids, assuming the step up in basis rule stays and all this other stuff and life insurance stays tax-free, it's parked in an islet outside of the taxable estate, $11 million tax-free estate transfer. I'm assuming mom and dad never keep any money. They spend every dollar they keep. We all know better. They're going to keep some of that money and continue to build their wealth. Oh, by the way, charity is going to pick up $7 million that otherwise would have been given to the IRS. Total wealth transfer here for the kids and charities, 18. All because we chose not to pay $7.3 million in the no tax plan. John and Mary have a son that died of a traumatic brain injury. And so they want to make certain that this charitable gives continues to give in perpetuity. So they're going to have the charitable trust upon their death roll into a donor advised endowment. And then that endowment is going to give multiple charities $275,000 a year in perpetuity. This is where people stop and go, oh my gosh, I never thought about being a multi-million-dollar donor. Here, yes, we're playing with $11 million. Take off a zero, you're playing with $1 million. $100 million, add 2 zeros. The point is this, I don't worry too much about a percentage point here or there. When I can get the client to focus on the value of what's going on, they really don't care about paying a little tax here or there, not getting the full carry forward, when they're able to see the full value and impact of their wealth being used in a way that supports what's important to them. I'm always asked, Ed, what are the secret sauce ingredients to do some type of effective tax design? 3 things that are always common are these: some type of insurance thingy, a business or trust thingy, and a charitable thingy. It's like 3 legs on a stool. It's never just one thing. People go, well, Ed, we want the charitable thing to do everything. No, the charitable thing by itself can't solve all the issues. So it's typically these 3 things are the starting point of helping the client have the maximum tax efficiency on the sale of their business. So what I think we're going to see as advisors this year is a lot of last minute sell your business. You get called at the last minute saying, hey, by the way, I just sold my business and I've got $3 million sitting in my checking account and I've got about $1 million tax bill. What can we do post-transaction? Another rarely used concept is the grantor's charitable lead trust. Now, the other 2 types of charitable lead trust here are non-grantors. So the difference here is the grantor's lead trust is a trust where I can fund it today, get some tax deductions. I can be the trustee. I pick the number of years. But the thing that's great about the grantor's lead trust is it does not have the age component calculation like the charitable remainder trust does. So if I have somebody 35 years old and they're trying to put $1 million into a charitable remainder unit trust, it's going to be very unlikely they pass the 5%, 50%, and 10% test. Whereas with the grantor's lead trust, I don't have to worry about that test. I've got to worry about the amount of money going in, the percentage that's going to go to charity, and how long does the charitable lead trust run. Now, remember, when it's a grantor type trust, any tax created in the grantor's trust flows over to the client to pay taxes on. So whatever we fund this grantor's lead trust with, we want to fund it in such a way that it does not start creating taxes. So for example, I would not put a rental property into a grantor's charitable lead trust because that produces rent, which produces taxes, which defeats the whole purpose of what we're trying to do here. So the grantor's charitable lead trust, the client picks the number of years. A common one is 10 years. The cool thing about the grantor's charitable lead trust is when the trust is done, whatever's left in the trust goes back to the grantor. Now remember, on a charitable remainder trust, they get an income stream, and then when they die, what's left over goes to charity. So this is almost the exact opposite of a charitable remainder trust, charitable lead trust. Okay, one's an apple, one's an orange. We want to fund these with cash, not stock, not real estate. So the client just sold their heavy cash. They're freaking out end of year. They need some tax deductions. They have nothing else to work with except Schedule A line 14. Oh, wow, what a surprise. So if they're younger, okay, this is great. It even works for older people, but I'll talk a minute about why older people is an issue. Income tax deduction, present value. All right, I like that too. It is a taxable trust. Avoid rental properties, anything that creates a distribution of income or recognition to the client. And I like using younger, healthy grantors and married couple. A scenario where I would be uncomfortable using the grantor's charitable lead trust is if I have only one person to work with, a single person, they're over 65 or 70, maybe they have some health issues. Because remember, if the client dies during the term of years for this charitable lead trust, we end up with a bit of a tax inefficiency. It's not a good thing. So I like using it mostly with married couples. I like using it with people that are younger. The total number of charitable lead trusts in operation in the nation reported by the IRS 2 years ago was less than 8,000. It gets talked about a lot, but it's rarely used. I believe this year and even next year, when we see sellers selling and going to cash so quickly with no tax planning opportunity, I think the charitable lead trust is a healthy tool to work with because the client gets tax deductions now and they get the assets back in the future. And if it's like a 10-year term of years and the equity play here is to buy assets that grow in equity, there's a strong chance they're going to get back the full value of their initial gift plus some, but we can never represent it like that. So the lead trust is a great investment strategy that I like to use a growth portfolio and a 30% tax-free bond fund. Now remember, this charitable lead trust, let's use 10 years, has got to give X amount of money to charity every single year. So let's call it a 5 or 6% payout. We're going to give the charity the bonds. Remember, I want to create no tax issues to the client. So the goal here is we're going to take 30% of this value, structure it in bonds, let that be the piece of the puzzle that blesses the charitable distribution requirement for the next 10 years in this case. And at the end of 10 years, hopefully the growth stock portfolio has now replaced the money that I gave to charity. And so in theory, we should be able to get back all the assets that we put in and it transfers back to the client. These can be paid out to a donor advised fund. So a lot more flexibility to work here. They can go straight to charity. You can reserve the right to change charities every year if you want to, but the easiest thing to do is just a donor advised fund. The money gets distributed from the charitable lead trust to the DAF. The DAF in turn, you get to make the recommendation to the DAF to say, hey, we want to give this much to this charity. This way you're not stuck in something where every year it goes to a charity, because what if in 3 years one of the charities you don't like anymore for whatever reason? The goal when I talk about the charitable lead trust is to help the client get some tax deductions now to soften their tax bill so that they can try to get these assets back and hopefully make the grantor back at 100%. We can never represent that, but we can say the goal is for the trust to give you these assets back when the trust is done. If you want to learn more about a charitable lead trust, just send me an email and I'll send you down some information on how we do that. This is what it looks like. We put $500,000 in. We have a 10-year term. The client's going to pick up about $140,000 of tax deductions in a year that they're probably going to need it. We're going to give 6% a year to charity. So charity is going to get a nice gift over the next 10 years. And then just using a very modest replacement here, $500,000 of assets come back to the client. Totally cool structure. I love this thing. Remember, the client gets to pick the number of years. So they want it to go 5 years, 10 years, 20 years. It's beautiful. Now, one of those poor people like Mr. Buffett, he did a multi-billion-dollar 4-layer charitable lead trust. It is in his case, it was the non-grantor model. which means he was able to transfer piles of money to his heirs, gift, estate, and income tax-free using a tax-free muni bond portfolio structure over the course of about 2 decades. It is a powerful tool. It is complex. Few attorneys have ever done one. That's one disadvantage. All right, are we ready for another polling question, Rod?
Yes, we are, and we'll bring it up right now. And you got 60 seconds to register your attendance.
Okay. I went ahead and called President Biden and got all the answers for the tax proposal, so I'm going to share those with you. The phone rang and rang. All right. There's 3 major bills up there. Lots of confusion. My sources on the Hill are basically saying C Corp, both sides of the aisle, are settling around 25% for the C Corp tax rate. Still lots of problems with the step-up rule, lots of problems with the gain tax. The income tax stuff, I think, is pretty much going to work. There's still issues in respect to the Social Security tax. In other words, it's going to be impossible to advise a client on what to do. The one thing that I think we do need to be papering our file, particularly for our clients who have a net worth of more than $3.5 million per person, I think it's wise to call those folks and say, you know, if you think you've got an estate more than $3.5 million per person, you need to talk to your estate planning attorney right now. Paper that in your file, because what I don't like happening is when the client calls and says, why didn't you tell me that there was going to be an onerous tax rule and now I'm going to have an estate tax thing? I think the more we do a better job of papering our files and trying to keep the client informed, the better we sleep at night and the better the client sleeps at night. So the unified credit, I think that's something we've got to go through again this year in order to avoid the same thing. For those of you old enough, you remember 2009 when we had the last tax law change and everybody was running around prior to that sunset provision. It's the same thing. I was on the phone with a guy named Jonathan Blockmacher a couple of months ago, and he was really pointing out the issue of paper your files, and he really went to town. Mostly attorneys were on that call, but something else that he said kind of struck me pretty good. He remembers as a young attorney back in 1986 when the largest tax reform act we had ever seen was being put into law. And he said, I remember the senior attorneys and accountants that I was working with, the gray-haired people, when they saw the impact of the Tax Reform Act and they figured out how much training they would have to go through to once again become proficient at such a change. He was amazed at the number of people that just retired. They're like, I'm just not willing to spend another 5 years learning a new tax system. It's just crazy. He believes we're going to see something like that again. So it is going to be a big reform act if 2/3 or more of it's approved. Lifetime credit is the big thing, $3.5 million, and they'll step up in basis rule eliminations. I mean, when you stop and think about those 2 changes right there, how many of your clients would be subject to this new estate tax or income tax planning that's proposed? I just don't see it happening, but you know, they don't call me to ask that question, should they approve it or not? I want to talk a moment about IRD assets as we kind of get down to the end results here. 30 years ago, when you talk about IRAs and 401ks and other types of qualified pension plans, our clients didn't have a big one. They had a house, they had a business, and maybe they had a couple of bucks in some type of qualified plan. Today, we look at our clients, they have piles of money in their qualified plan, maybe a house that's usually less in value than their qualified plan, and they might be subject to estate taxes. I want to spend a moment about something that I think is going to be a hot topic if we end up with a $3.5 million unified lifetime credit. And if everything just becomes ordinary income to the client and their heirs with no step up in basis, that's just going to be unbelievable. But I think all of us know the term income in respect of a decedent, IRD taxation. So any type of qualified plan that transfers to my heirs, other than my spouse as far as a rollover, any plan that goes to a non-spouse beneficiary is always ordinary income. Okay, we know that. When we have that income come to the client, technically there's not what we call a deduction in respect to the decedent because they didn't pay any estate taxes on it. But if they do have to pay estate taxes, this conversation changes big time, where we begin the discussion of both double and triple tax traps. If we end up with a $3.5 million exemption, we're now going to be called upon to do the Form 706. I mean, most advisors haven't had to touch a 706 in 11, 12, 13 years because of the large exemptions that we got. So it is a lost art out there where we're going to once again have to figure out how to do 706 as well. In the proposal by Biden, it does have the same exclusions for the 2053 deductions, the administrative cost of doing a large estate, all of those things. I did not see anything about 691C, which is the IRD, DRD component. So let's put that in perspective. I have a single client who has a unified credit value today of $11.7 million and an estate today of $11 million and an IRA of $5 million. So under this scenario right here, they have no estate tax exposure whatsoever, but we do have, rounding numbers off here, about a $2 million tax loss when the kids inherit this $5 million IRA, okay? And it could have been worse, but I'm just using 2 million to make the math easy to understand. So today, my client with $11 million and $5 million IRA, no estate tax, but we do have a $2 million income tax bill for the kids. If we change that same person's estate to a $3.5 million unified credit, now we have 3.5 on 11 million, 40% estate tax between 3.5 and 11 is 3 million. We still have the IRD component to the kids, but a portion of that $3 million is technically deductible. The kids can claim it under 691C if we still have 691C as deductible. Here's the problem with the deductibility of the estate taxes that the estate paid using the IRA assets. The heirs have the right to claim a deduction because mommy and daddy's estate 706 did pay some portion of that IRA as a tax bill, IRD. My question to you folks, where do you claim the children's DRD tax deduction? I've talked about 100 tax professionals over the last several months because I'm doing some research on a new book that I'm writing about IRAs. One out of nearly 100 professionals knew that you could claim the DRD deduction for estate taxes with an IRA that was involved. One knew where to claim it. And as you do your search through all the forms, guess what? There's not a form. For the heirs to claim the IRD deduction, it goes on Schedule A, Other. Schedule A, Other. So let's say mommy and daddy paid $500,000 in IRD tax as part of their 706. The kids have the right to claim that deduction on their 1040. And by doing so, it saves them from some extra tax penalties. And so in this chart, on the left-hand side, for a family with $1 million IRA, it goes to the kids using 40%. We pay $400,000 in IRA tax. The kids go home with $600,000. Yeah, we've got this new 10-year rule, which I'm not a fan of either because there are some technical issues there that I'm still concerned about. The middle column here shows the children getting $1 million IRA from an estate that was subject to estate taxes. So we had a 40% haircut for estate taxes. Then we have the income tax, and then we have the net to family because those kids had a tax professional who knew how to claim the 691C deduction so that they only lose about 61% of the value of the IRA. Kids get to go home with 39% because mommy and daddy had a good tax professional and their tax professional was on top of this. For the tax professionals or the kids who think they're tax professionals because they do their tax returns online now, they're not going to know that there's potentially an IRD, DRD tax deduction they can claim. And by not claiming the 691C tax deduction on the kid's tax return, they will net between 20 and 23% of the value of the IRA, assuming they live in a state like Nevada, Texas, Florida, etc. So when I talk to families about how much money they're shoveling into these qualified plans, and if they're going to be subject to estate taxes, we start talking about the tax issues associated with qualified planning. It's already a 61% tax bill under the best case scenario. So if the only reason they're putting money in these qualified plans is so they can theoretically get some type of tax deduction, why don't we start putting money into a charitable remainder trust that can give them a lot better tax deduction? They can set up the charitable trust so they keep adding money to it over the years. And then they can even set up the charitable remainder trust with a trigger mechanism so that when they sell their business one day, they can then tell the trustee to turn on the income to start getting a cash flow from it. Overwhelmingly, when I show a family that is subject to estate taxes, the tax benefits of using a charitable remainder trust to get bigger tax deductions and to create a new retirement income source that won't be subject to estate taxes. And then we can still spend some money on a life insurance replacement value product so that whatever we put in the charitable trust as a play, it helps solve this problem. Kids would rather inherit things that have zero tax versus inherit things that come with a 61% tax haircut. If the Biden plan comes out with a $3.5 million or $5 million, some type of lifetime unified credit, we're all going to be dealing with a lot of this because a lot of our clients are going to be worried about this as they learn about it. So if the Biden proposal keeps 691C in place, kids inherit 39%. If we lose 691C, or if the children's tax professionals fail to claim the deduction, the kids lose. They only get 23% of the IRA asset. Rod, is it time for another question?
It is. And let me see here.
I wonder what it's going to be.
Okay, here we go. You got 60 seconds to mark your attendance. Okay, Ed, you can keep going.
All right, we're on the final stretch here. All right, so even though people go, well, what does this have to do with exit planning? It has a lot to do with exit planning, because if our clients are just going to focus on the sale of their business, but every year they're shoveling all this money into qualified plans, and if we're going into a tax adverse environment for people that are considered rich or wealthy at $3.5 million by the IRS, this is an efficiency play that we have to start talking about and educating our clients that, hey, maybe there's better things to do than just shoveling money into a deferred comp defined benefit, whatever kind of plan. There are ways to create much larger tax deductions. And once again, we have created the threshold of helping the client find a way to make charitable tax planning profitable for them. And then when they sell their business, you come back to the table, have you looked at the charitable lead trust? Maybe we'll do another charitable remainder trust with this pile of cash that you have, provided we pass the 5%, 50%, 10% test, et cetera. The point is, the client is now seeing the value in doing charitable tax planning versus some of these extremely risky things that I see out here where the IRS just absolutely hates these things. I was in a case model recently where they were telling me what they were going to do. And I'm like, you do realize there's 3, if not 4 other easier, simpler, audit-proof ways to do what you're trying to do. And so sometimes it's just a matter of looking at everything going on. This is what I try to do as the framework when I work with families. I try to move them from the red and green box at the top with charitable tax planning in such a way that we have income and wealth that exceeds their goals, piles of money going to worthy charitable causes. We still have some tax, but compared to the size of the tax red box on top, this is kind of a no-brainer, isn't it? So I call this engineering maximum wealth control. It helps families do things. Here's a list of about 60 different things as far as tax elimination, tax deferral. There's a lot of ways to go here. Overwhelmingly, most of these don't work with every single client. The question becomes, when we're having this discussion with the client about exit planning and tax strategies and that type of thing, which one is best? And there's really not a software system out there that can take all of these things. There are some software systems coming out that are trying to bring a few planning tools to the table where we can run some illustrations and projections, versus using a spreadsheet. I mean, one of the largest insurance companies in the nation, when they do some of their illustrations as far as forecasting clients and that type of thing, they're still using spreadsheets. And I'm like, how do you use a spreadsheet to do that type of work? Because it's so easy to be off a point or two or there. Yeah, we have this big compliance department. Every month they go through it. We need good software to help us do better planning for our clients. So as we start wrapping this thing up, the tax train is coming, we think. The question that our clients keep hearing is it going to be retroactive to 1 January 2021? Is it going to be effective on the date of the Tax Reform Act? Is it going to be, we don't know. But we do know that there's some technical issues we need to be very thoughtful about. The step up in basis thing where it's got a modification of 500 to $1 million ordinary income under the STEP Act that was proposed. I pray to God it doesn't get approved, because my first question to the tax professionals is, show me how you report this. How are you going to put this on a tax return? Changing the exemption to 3.5 million per person, or 5 million, or 5.5. Well, I was talking to Robin Klomparens, one of the top tax attorneys here in California. She goes to Washington, D.C. all the time to work with our leaders in respect to providing them advice about tax and the code and that type of thing. And she shared with me a couple of months ago, she said, Ed, when we were looking at the TCJA and all of these things where the Tax Reform Act, and we got up to $11 million on a lifetime exemption, we never thought that was ever going to be approved. We thought that it was going to be somewhere around $5 million with a cost of living adjustment in it, because that's what made sense. That's what worked better with the tax code and that type of thing. She says, we never thought we'd see $11 million lifetime exemption. So realistically, I think it should be down in the $5 million number somewhere. I think is appropriate. It falls in line with what the code has done all these years. So I think that's a good one. The long-term capital gains one, the different thresholds and turning it into ordinary income. The concern I have there is if you do such a radical change in respect to changing the long-term capital gains treatment, will it cause investors to sit on cash and to not make investments? I think that if this rule were to be passed, we would see a huge retraction of investment capital. I just don't see a value in it at all. States are jumping on board now with this new state capital gains tax. Washington passed into law effective next year, a new 7% or so capital gains tax. I expect to see many other states to follow that as well. Washington has also passed a new long-term insurance plan act where they're going to make mandatory that you have long-term care insurance. California has that legislation ready to go. So do other states. I do expect California to follow suit probably in less than 3 years or so. The governor just signed some huge Medi-Cal acts this last week, and the PACE program. So we're going to see an overhaul of the whole long-term care system here in California, particularly for Medi-Cal and skilled nursing treatment over the next couple of years. So that's definitely up in the air. Income tax brackets. Multiple times I've heard representatives say that we're not going to increase the taxes on anyone who makes more than $400,000 a year. But when you dig into the Biden plan, one thing you can definitely find is that currently someone who makes $400,000 a year, married couples, probably around a 24% tax rate federal. Under the Biden tax plan, same family, same income, they're going to be in the 25% tax bracket at about 160,000 and change. So I don't know how people are saying we're only going to tax people who make more than $400,000 at a higher tax rate, when they clearly have lowered the bracket threshold in which people become subject to a higher tax rate on the money they did make. The add back Social Security, in other words, 12.4 on the first 130,000 and change, and then nothing up to 400, and then at 400 we're back into 12.4% Social Security. I think most of America would say that's okay for these wealthy income earners to pay more Social Security tax. considering how many voters there are that make $400,000 a year, if this was left up to vote, I think most of the nation would say, let it pass. Congressionally, I don't know if it's going to get across the line because everybody in Congress probably makes more than $400,000 a year. Key planning opportunities that I think tax advisors really need to be looking at: conversion of qualified plans. And the point I want to make here, interest rates have been historically low. And I advised a client recently to go get in his pickup truck and go to the bank and borrow every penny he would let the bank give him. And he's like, why is this? I'm like, what do you think the chances are money's going to be this cheap and this easy to get 2 years from today? We already saw a couple of major banks in the last month started canceling lines of credit for some of their clients. We're seeing a lot of banks going to more cash reserve now. That's an indication to me that we're probably going to see interest rates popping up within the next year or two. But right now, for clients who need cash, they need to go get it right now and get as much cash to have in their war chest and be ready for expansion, because there's going to be some opportunities to grow their business. But in respect to qualified plans, if I convert my qualified plan, it creates a big tax event. Okay, we add a charitable planning structure here to help offset part of that tax bill. And then if I know money's cheap and the client's insurable, this creates a scenario where we take some of this cash, use it as collateral, use that to buy life insurance, which can be structured to create zero tax income in their future years. Now, this got complicated in a hurry, didn't it? I just put 4 different strategies together just to convert, let's say, $1 million IRA. And if they're subject to estate taxes, why in the world? I've got a case going in Ohio right now, $50 million net worth, $4.9 million in qualified plan for 2 doctors. Why in the world do they have $4.9 million in qualified plans in an estate that is already subject to estate taxes under current law? It just makes no sense. So now they want to convert or liberate that entire $4.9 million and convert. Well, that's an ordinary income tax event. Well, we need a charitable planning event to help offset part of this tax bill. And then let's go to the bank, let's borrow money, and let's create some life insurance structures and that type of thing to be zero tax for themselves and zero tax wealth transfer to the kids. Now, folks, we began this discussion with the exit planning scenarios of business transfers. When we get down to what this is always about, is I want to sell when I'm ready for the money I need to the people I choose. That is always the core component of the discussion with the business owner. Then it turns into the transactional tax event. And that's where we as a community can help our client and their other advisors figure out more tax efficient ways to help turn this horrible tax event into something that, one, can create tax deductions, create income streams for the client, and create monies for worthy charities that's going to help this nation save a pile of money and reduce the tax burden that we all have. Now, I hope in the last hour and 35 minutes, I haven't caused you to rethink doing anything other than I need to be spending more time on this. We all need to be spending more time learning about exit planning strategies, tax modeling systems, and various things, because if we do go into an onerous tax environment, the demand for competent, qualified tax professionals that can provide sage advice is going to be needed now more than ever. We're going to be looked to by the client and their advisors to say, is there a better way to make this less tax painful? And I'm here to tell you the charitable tax planning opportunities are tremendous when you cultivate that opportunity with clients. Yes, I love life insurance. Yes, I love qualified plans up to the lifetime maximum, as long as we're not subject to estate taxes. Yes, I love everything we can do with C Corps and S Corps and all of those things. I love it, love it, love it. But when I have a transaction with a huge tax bill, typically some type of charitable tax planning strategy is the solution set that's going to help us and our clients hit their income numbers that they need for the rest of their lives. Now, Rod, you guys said you're going to watch for the questions and stuff. Do we have any questions to be talking about as we get ready to close?
We don't have any yet. If somebody wants to pose them out there, this is a good time to do it.
And folks, for any of you listening that want to have some input, just send me an email saying, Ed, I've got a question about this. Do you have any thoughts on that? Remember, my website at Olympus Tax has a lot of white papers about exit planning, getting the business owner to start thinking about how to start preparing for his exit plan, building his or her team, that type of thing. I spent a lot of money on those things. So please go use them, print them, distribute them as you see fit. But they are copyrighted because I had to pay for them. But a lot of this stuff is simple stuff. What's the maximum amount that my client can claim on Schedule A line 14? And then build out a solution backwards from there. And overwhelmingly, do you need income now? No. Do you want income later? Yes. Do you want assets now? No. Do you want assets later? Yes. Some of this stuff gets real simple. And then from there, you get to figure out which one of these charitable tax planning strategies works best. Okay. So feel free to send me an email, give me a phone call. I will tell you that as far as tax planning advisors that do this type of work, I'm already getting a lot of pushback from attorneys and accountants who do high-end tax planning telling me we can't take any more new clients this year. We're booked for the rest of this year. Our existing clients are driving us crazy. One of my top attorneys, I serve on a board with him at a huge charity down in Los Angeles. I said, hey, I need a huge favor. Can you help me out? I need a speaker in November to talk about slats to my estate planning group that I'm a member of. He laughed. He said, are you kidding me? You want us to stop what we're doing in November to do a seminar? No. It's going to be crazy the last 3 or 4 months of this year. So the sooner you can talk to your clients about preparing for end of year tax planning, the better. I'll tell people all the time, 1 November, you should have all your decisions made about this year's tax planning, which may include selling a business. All those decisions about if we sell, what are we going to fund, how are we going to do it, needs to be decided before 1 November. And then prayerfully, you hopefully will have access to an advisor that can help you design, structure, fund that model so that you can get it in place before the end of the tax year. It's been a pleasure talking with you. Are we at the 1 hour, 40-minute conclusion time, Rod?
We're right there. There is one question for you, and that is from Ellie, I believe. And it says, if you have a client that just sold their practice and they have a 1.1 times 3 partners, what will be your recommendation?
Couple of things. If they're healthy and younger, the grantor's charitable lead trust is a powerful tool to get some tax benefits. Okay, with 1.1, they're probably going to have a tax bill between $300,000 and $400,000, which means they're going to take the remaining money to either use for retirement or start another business or something like that. So the charitable lead trust could give them some tax deductions. If they're older, the charitable remainder trust. So if they're 60ish and older, the charitable remainder trust also has some good tax deductions, which means if they're 60 and older, they probably want a retirement income stream to start as soon as possible. So the charitable remainder trust would be a great tool for them to look at, throw $300,000 or $400,000 or $500,000 cash into it, get some very generous income tax deductions. And now they have $500,000 producing, say, 6% a year, $30,000 income stream for the rest of their life. The charitable remainder trust is a good one. If they're young and healthy, another strategy that I've seen float very well is to use life insurance and bank financing to basically borrow money and use that to fund life insurance by taking some of their $1.1 million and use it as collateral to borrow money. Because when you think about it, if I can borrow money at this cheap of a tax rate and then just pay my tax bill next year using the life insurance bank funding mechanism. So I'm going to borrow $400,000 from the bank and then pay off my tax bill by April 15th next year. So I've got full safe harbor, no audit risk whatsoever. And then I let the bank insurance strategy pay off that loan over the next 8, 9, 10 years.
Hello, Ed. Well, I don't know if we've lost Ed. Looks like maybe we've lost connection with Ed.
right, well, in that case, thank you, Ed, so much. If you can hear us, thank you for an excellent presentation. That was really fantastic. And thank you to everyone for attending our webinar today. You will receive an email within 24 hours of the meeting with the meeting evaluation form, session materials, and a recording of the session. The CSTC office will email a certificate of completion within the next 3 business days to all attendees who've met the polling requirements for CE credits. As a reminder to anyone who's with us today, who is a non-member, if you join CSTC during the Wednesday webinar series, you can use our discount code WWS21 to receive $25 off your membership. Please visit our website, cstcsociety.org, and you can find a complete listing of all of our upcoming webinars. You can register webinars, and you can learn more about future topics included in our Wednesday webinar series. We hope to see you next week, and please enjoy the rest of your day.